Today I would like to analyze Procter Gamble. So they have a diversified portfolio of different brands. We can see here most of their products and they are very known worldwide. If we take a look at the stock price, we can see we are up 43% over the last 5 years. So today we're going to take a look at their financials to find out if this company is undervalued or overvalued right now. So the first thing we can recognize is the huge market cap of 413 billion US dollar. So it's already a big company, which can mean they can have more difficulties to grow in the future. We can see the dividend yield is 2.29%, which is not very huge in comparison to in the past. So we can take a look here and we will see in the past the dividend yield was also sometimes over 3%. And we can also see here the dividend increased many years in a row. So this is what we like as well. They have a good dividend growth. So now we're going to take a look at the financial foundation. So the first thing we are looking for is revenue growth over the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2019, it was around 67 billion. And now in 2023, it was around 82 billion. So we have the increase and it's in a good rate as well. So we're going to make a check here. Now we're going to take a look at the free cash flow. We want this to grow over the last 5 years. So the free cash flow is very important because this is how the company pays the dividend or can buy back their own shares. So we can see here in 2019, it was around $11.9 billion. And now in 2023, it's around 13.79 billion. So we have the increase as well, but we also had the decline from the 2021, we can see here. So it's still a check here and we like to see that. So now we're going to take a look at the free cash flow yield. We would like to see that over 4%. So this can also tell us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued or it needs to have a more free cash flow growth in the future. So we're going to take now the free cash flow from 2023. And then we're going to divide it with the market cap that we have. So then we're going to get the free cash flow yield. So the number we get is 0.03336, which means around 3.33% free cash flow yield. So it's under 4%. We don't like to see that. It could mean the company is overvalued right now, but we're going to take a look at other financials as well. So we are looking for the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. So it's very important as well, because if the company has too much debt, it could risk to go bankrupt. So now we're going to take the short-term debt first. Then we're going to add the long-term debt as well here. And then we're going to divide it with the free cash flow. So we're going to get the debt to free cash flow ratio. So the number we get is 2.56, which means in a little bit under 3 years, we can pay back the debt with our free cash flow. So this is a good number, actually. It's under 5, so we like to see that. We can also take a look at the cash on hand. So how much money the company has in the bank. We can see here it's around 8 billion, which is not bad. I mean, compared with the market cap, it's not very much, but it's still not a bad number. So the last thing we're looking for is shares outstanding decrease, especially if we have already the accomplished business. So this is a huge company already, so we would like to see them buy back their own shares, especially if we think the company is undervalued. So we can see here, they did buy back shares in many years, especially in 2021, over 4% of their outstanding shares. So it would be a check here, but we also have to think they should not buy back their own shares if they are overvalued. This is also important. So I would like to give my conclusion about this company. So let's start with the good things. They have the growing revenue and the growing free cash flow as well. So this is what we really like to see. They have the good balance sheet as well, which means a not very high amount of debt and a good amount of cash on hand as well. So they have the growing dividend over many years, which is really nice. So the negative things would be the low free cash flow yield. It's just 3.33%. And the low dividend as well is just 2.29%. What I also don't like, they have a lot of competition. So especially other supermarket brands. And I don't really like this competition because they can sell the product way lower. And so they have to make the good products to keep the competition away. So they need to get the popularity from the consumers. So I hope you enjoyed this video, and please leave a like and subscribe to support this channel.